Welcome back to The Explainer. I'm so thrilled you're here today because, well, we've got a seriously fascinating deep dive lined up. Today, we're putting the Franklin Asian Equity Fund squarely under the microscope. Look, as global markets go through these incredibly rapid, almost crazy structural shifts, geographic diversification, it's really transitioned from being just a nice to have tactical option into an absolute strategic necessity. So, we're going to unpack exactly how this fund attempts to capture the massive Asian megatrend, the underlying mechanics, and, of course, the specific advantages it brings to the table. Let's get right into it. Okay, let's dive into this. I want you to honestly ask yourself a question as you look at your current investments. Are you sitting on a purely domestic portfolio right now, kind of wondering if you're missing out on the world's absolute biggest tech hardware boom? Because here's the reality. The massive artificial intelligence and semiconductor waves, they aren't just happening in your backyard. If your money is only parked at home, you might literally be missing out on the very infrastructure that is building the future. Let's zoom out for a quick second and look at the macro picture of Asia. We are talking about undeniable, absolutely massive tailwinds here. You've got the explosion of AI infrastructure, huge demographic shifts supporting long-term consumption, and the undeniable fact that the Asia-Pacific region is quite simply the world's fastest-growing economic corridor. I mean, from shifting global supply chains to just outright dominance in tech manufacturing, this region is a powerhouse, and that is exactly what this fund is designed to target.
Section 1. What is the fund? The Gateway to Asia ex-Japan.
Now, what's really interesting about this is how the fund acts as a totally seamless bridge. Look, for a retail investor sitting in India, trying to buy into complex foreign markets can be, well, a massive operational headache. Normally, you'd have to deal with international brokerage accounts, crazy foreign exchange fees, the whole shebang. But this open-ended thematic equity scheme actually routes your Indian rupees directly into Asian growth companies using your local currency. It completely removes the friction of international investing. You get direct access to the Asian growth story without any of the administrative nightmares. So let's quickly define the core mandate here, the Asia ex-Japan strategy. What does that actually mean for us? Basically, it's an investment mandate focusing intensely on the raw emerging market expansion and the high-value tech manufacturing base of the Asian region. And crucially, it strictly excludes Japan. Why? Well, excluding Japan intentionally positions the fund to capture the most aggressive structural growth and emerging market dynamism. Japan, as you know, is a mature, slower growth economy. This fund, it wants to capture the explosive, rapid scaling phases of the broader Asia-Pacific region. Moving on to Section 2, the dual engine strategy, balancing growth and stability. Take a look at the country-wise allocation here. This isn't just some fund that takes your money and goes 100% offshore into completely unfamiliar territory. Notice that massive domestic anchor? Nearly 40% of the portfolio is actually rooted right there in India, and that sits directly alongside heavy, really high conviction allocations in major East Asian markets. We're talking China, Taiwan, and South Korea. And this brilliantly illustrates how that dual engine analogy works in actual practice. On the one side, you have the India allocation. At roughly 40%, this acts as a really powerful buffer. It protects the overall portfolio against the severe geopolitical and currency volatility that you usually get with purely international investing. But it's still capturing India's strong domestic consumption and financialization trends. So think of familiar, stable Indian blue chips. Then, on the other side, the East Asia allocation fires up the high-octane growth engine. This taps directly into premier manufacturing, technology exports, and pure hardware dominance in Taiwan, Korea, and China. It perfectly balances the safety of the familiar with the aggressive growth of global powerhouses. All right, Section 3, dominating global tech hardware, the AI and semiconductor boom. Let's move to the holdings and see how this builds, because when you review the top 10 holdings of this fund, the investment philosophy becomes crystal clear. Look at that incredibly heavy concentration of assets sitting right at the top in the information technology sector. We aren't looking at generic tech or consumer software names here, no way. We're looking at a high-conviction approach targeted squarely at the absolute giants of East Asian technology and semiconductor manufacturing. So, why do these specific tech giants matter so much? Because investing here means owning the physical infrastructure of the AI revolution. You've got Taiwan Semiconductor Manufacturing Company, or TSMC, representing a major chunk of assets. As the world's premier advanced logic chip foundry, they hold a near monopoly on high-performance computing hardware. It's wild. Then you have South Korea's heavyweights, Samsung Electronics, the global leader in memory semiconductors, and SK Hynix, an absolutely critical player in the global tech capex cycle. Put them together, and these holdings make the fund incredibly sensitive to the global artificial intelligence structural megatrend. You're literally buying the foundational hardware that makes the digital future possible.
Section 4. Performance, Risk, and Taxes, the Reality Check.
So the crucial point here is understanding the actual real-world returns. And wow, this number is certainly eye-catching. 55.47%. That is the massive one-year trailing return for the direct growth plan as of June 2026. This exceptional performance easily outperformed broader international category averages, and it was primarily driven by an explosive cyclical recovery in those exact North Asian semiconductor and tech stocks we just talked about, right alongside robust domestic market performance in India.
However, we've got to look at the complete picture, right? Let's impartially contrast that massive one-year surge with this number, 8.65%. That's the 5-year annualized return for the fund. Now, why the stark difference? Well, this lower annualized number perfectly demonstrates the cyclical volatility and the historical realities of the region. Over the past 5 years, the fund had to navigate post-pandemic regulatory crackdowns in China, plus global economic slowdowns. It's a vital reminder that while the highs can be astronomical, the region is definitely subject to cyclical headwinds, so this requires a patient, long-term outlook.
So let's clearly lay out the practicalities, so you have the completely unvarnished picture. On the cost front, the direct plan features a highly competitive expense ratio of 1.15%, which is actually very efficient for an international thematic fund. But the risk profile is officially rated very high because of the foreign exchange fluctuations and global market exposure. You've also got a 1% exit load if you redeem your units within 1 year. And crucially, this is important for Indian tax purposes because of its substantial international asset base, it's treated as a non-equity fund. This means short-term capital gains are added to your taxable income slab, while long-term gains, meaning you hold the investment for more than 2 years, are taxed at a flat rate of 12.5%. Knowing these operational realities is absolutely key to optimizing your portfolio.
Which brings us to our final provocative question for you to ponder today. Does a dual-engine strategy of domestic stability and global tech dominance actually align with your personal 5-year investment horizon? The Franklin Asian Equity Fund offers a highly strategic, targeted gateway to the Asian megatrend, allowing you to own the literal infrastructure of the AI revolution, all while keeping a steady anchor at home. Is this the right thematic play to diversify your portfolio? Well, I hope this explainer has given you the clarity you need to explore that further. Thanks so much for joining me today, and as always, keep learning and keep exploring.